And still with us in studio this morning is Jean-Pierre Faster. He's an analyst at 361 Asset Management. Joining our conversation as well is John Cairns, who's a currency strategist at RMB. Thanks so much, John, for joining us today. Well, let's start off with the headline the business day is running with this morning. Rand's fall sinks hopes of reprieve for the currency. Do you agree? To what extent do you agree?
Yeah, it's a pretty good headline, actually. I mean, we obviously had a terrible May. A run on the Rand in May, one of the worst months ever on the Rand, the fourth worst in history actually. Coming into June, some stability as the Fed fears subsided. And then after payrolls now, it's just been consistent weakness in emerging market currencies, emerging market bonds, foreigners selling out of our bonds. And so it does look like the Rand is at scope for potentially another run weaker.
Let's deal with local and then global issues separately here, because yes, we've got plenty, of the local issues currently plaguing, but on the global scene, let's bring the US to the forefront. We've seen strength come through on the dollar specifically, and that on the back of this hope that we're looking at a recovering US picture. S&P's upgrade yesterday adding further impetus there.
Yeah, you're exactly right. We must focus on the global issues. It really comes down to global. The local issues are just add to the negative sentiment, but the real driver is, as you say, this fear over a Fed tapering. In other words, a relaxation of the pace of quantitative easing. And that feeds through in two ways. First, as you mentioned, a stronger dollar. The dollar was very, very strong, particularly in May. Not so much now in June, but potentially this coming back. And then the second channel is just all the trades that were boosted by the Fed's easy liquidity. So particularly emerging market bonds at this stage are coming under pressure as people think that could potentially. So really where we sit at the moment is potentially we've got an EM crisis on our hands. It's a very, very early stages to say that, but certainly emerging markets under a lot of pressure.
Yep, but emerging markets, Jean-Pierre, but also your commodity producing markets as well. I mean, we had China and its growth prospects raising a lot of fear, and that on the back of industrial data that has recently been released, putting pressure specifically on those commodity currencies.
Exactly. So the Brazilian real has been weak, the Australian dollar has been weak, and if you combine weaker imports of commodities from China with less risk appetite because of the possibility of Fed tapering, not a pretty cocktail for emerging market currencies, and then specifically commodity producing ones, and then you add labor unrest, and that means that's why the Rand is weakened so much.
Yeah.
I think what's interesting for me is if you look at the Fed tapering, where the pace of a decrease in quantitative easing is different than actually withdrawing stimulus. Mm-hmm. So what I'm interested is to see, as the markets grapple with this issue, whether people might have overreacted, and actually just decreasing purchases is not the same of stopping purchases, and therefore maybe the hunt for yield comes back, and you could see a strengthening again of these currencies. That could happen.
Yeah, how do you see that playing out, John, your view there?
Yeah, I think that's certainly our view, our core view at Rand Merchant Bank. Exactly as Jean-Pierre says, the fears are a bit overdone. They're talking about less easing of monetary policy, not tightening of monetary policy. But undoubtedly, it's causing a lot of consternation in global markets. EM bonds are really being badly hit. Our bond market is really in turmoil. And as long as that continues, the Rand will remain under pressure.
Mm-hmm. And John, how do you see the yen playing in through this? We've had a weakening through 100 versus the US dollar, come back to around 98. If you use that as a proxy for risk appetite, you would say it looks like there's also less risk appetite of people using the yen as a funding currency. What do you think will be the impact of the yen on global risk appetite?
Yeah, it's not that clear. As you say, typically the yen is a safe haven play. So the yen would strengthen when you've got uncertainty, the Rand would weaken, which is why, by the way, that Rand yen is the most volatile currency cross in the entire world. It's because they act in opposite directions. The yen has got different issues they're facing at the moment. Obviously the whole Abenomics, the printing of money, the fiscal stimulus in Japan. When Abenomics really got going in March, April, there was a lot of talk about possibly using the yen as a funder of the carry trade. As far as we can tell, that hasn't really been the case. In fact, generally what's been driving the Rand, it's been dominated by the bond flow issues. So it's mostly real money, maybe some spec money on the back of it as well, but the shift from developed world across to emerging markets, and hence why we always keep going back to the the tapering fears.
Yeah.
We had listened Mankis earlier referring to the change in the allocation, the asset allocation of Japanese pension funds and what that could mean for global currencies, because if you have Japanese pension funds diversifying away from the yen into other assets outside of Japan, looking for yield, that could also strengthen the South African rand and other emerging market currencies. Do you see that maybe playing out?
That has been a big story, but there's very little data to support that. So if you look at the flows out of Japan, in fact, the Japanese pension funds have mostly been repatriating money to Japan. I agree, it's quite strange. You would think the opposite. Maybe that play will come back in future, but for the past 2 months, there's been more talk than action, really.
Okay, so that's some of the global factors, and as you say, you know, primary drivers for what we're seeing on the rand scene. But we've got to take into consideration the local issues that have come to bear. And yes, we've been speaking about labour unrest now added to the fray. Electricity supply and concerns there, what that means for economic sustainability moving forward. John, your view, how do we factor these into the equation?
Yeah, I think it just makes a bad situation worse. So undoubtedly the core driver is still the Fed, and if the Fed fears can subside, the rand would probably stabilize. But for the moment, the rand is underperforming everything else. There's 2 reasons there. One is it's just its nature. It always outperforms or underperforms. It's always the high beta play, so it always does the most. But the other one, as you say, are these local issues. So it's been strikes. It's been significant negative sentiment. It's been the low growth environment. It's been fears of a rating downgrade. Now the market's been worried about it for a while, but now it really does seem to be the case that we're going to be experiencing load shedding. So all just adds further negatives to a very bad environment for the rand.
And if we are looking at the sustained weakness, what it has done is renew speculation in terms of the SARB's next move, that it may well, in fact, be forced to raise rates sooner rather than later. How do you see that playing out?
Yeah, I wouldn't jump the gun there. So there is still a possibility, we think, that you could have a rate cut. So if the tapering fears are overdone, if dollar rand can stabilize, and stabilize more than the level is probably the key issue. But let's say we come back to 950, even back to 9, with a lot less volatility, then the room would open for a rate cut. So we certainly wouldn't even rule out a cut at this stage. Where the rand is at the moment, no need for them to act. On hold for the foreseeable future. And the real interesting question is, at what stage the hike? So the market has started to price aggressive hikes. Let me rephrase that. Market pricing suggests aggressive hikes. But what really has happened is the market has been caught in a position. The market has had to clear out the position, so the interest rate curve has adjusted. So where the interest rates are at the moment is not really a fair reflection of what the market really anticipates. So if you look at the FRAs, they're forecasting, it's implying 2 rate hikes. I think that's certainly way overdone. I think everyone would agree on that. But your question is really, at what stage does the SARB look at hiking interest rates? Our numbers show a rand where it is at the moment, inflation will still fall back below 6%. If we push up to 11 though, the inflation forecast will be sustainably above 6%. And then you start really to get into an environment where they'd have to hike rates because of inflation. Okay, there's other reasons to hike rates. The other reason is obviously to try and protect the rand. But just from the pure inflation perspective, yep, if dollar rand gets above 11, then that rate hike really looks a possibility.
Globally, we've seen another round of rate cuts until recently, until the tapering fears came out again. So do you see that the SARB will be ahead of the curve, ahead of other emerging markets maybe when it comes to raising rates, or do you think we will wait and see rather than wait for other countries to raise rates first?
I think that's a good question. I can say the currency weakness in the emerging market space has already led to some policy response. So Brazil has hiked rates, and Brazil very notably unwound their tax. Remember the big inflow tax that they introduced when the real was so strong. In India, they've put taxes on gold imports. They're now talking about allowing sovereign wealth funds access to the domestic market. So we have had some response from emerging markets. Why would South Africa potentially be first? The major reason is that the rand is running ahead of everything else. So the rand is just its normal high beta status is running far faster. So maybe that could be the case. Would they wait for everyone else? I don't really think so. I don't think it's really going to make a difference. So it's really going to come down to the pace of rand depreciation or appreciation, the level on the rand and the inflation outlook.